Well, hello, everyone. Welcome to Getting Started with Technical Analysis. My name is Barbara Armstrong. I'm a coach and senior manager with the Charles Schwab Company. And today we are going to talk about popular technical indicators. I mean, there are probably, hundreds, if not thousands of indicators out there, but there are some indicators that traders tend to gravitate towards, and those are the ones we're going to focus on today. So you may be wondering what those are, and wonder no more. So we're going to look at moving averages. We're going to look at the MACD, or moving average convergence divergence indicator. We're going to look at relative strength, and just because I like it, we're going to look at average true range. So that's what we're up to today. And in looking at those indicators, we're going to have a discussion about one, where they show up on the Thinkorswim platform and on your charts. But we're also going to talk about why we might use them and what we'd use them for, and how we can use them to make more informed trading decisions with respect to perhaps when we enter a position or buy a stock or place an options trade, and then when we might choose to close one of those out. So if you are not following me on X, here's my handle. Consider this your formal invitation, my handle at Barb Armstrong CS. We also have the fantastic Mr. Ben Watson with us in the chat. He's a friend and a fellow coach. And if you're not following him, he's posting lots of great stuff as well at Ben Watson CS. He also, I'll be singing his praises in just a minute. So let's get through our important information, and then I can cover my one announcement before we dive into the world of technical indicators. So just keep in mind that everything that we discuss here is for educational and informational purposes only, none of it to be construed as a recommendation or personal investment advice. If we discuss options, know that those carry a higher level of risk and aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to learn, to hone your trading skills, to make sure you understand what you're doing with respect to your trading strategies, and how to place a trade on that platform. Looks like, smells like, feels like real money, but it's not. There are some nuances and differences. One is that short options will never be assigned early in Paper Money, and that can happen in a live account. So we gave this kind of a new face at the beginning of the year and created a 9-week rotation, which Ben covered for me brilliantly, in the 6 weeks that I was working on the Barb 2.0 project, which looked a lot like a knee replacement surgery. We are now into week 8, and today we're looking at technical indicators. And I may just throw a lesson 10 in there, so you'll just have to stay tuned. I used to do one in Getting Started with options that was called the 7 things I wish I'd known about trading when I started, and I may just move that over here. So stay tuned for a week 10 after we discuss divergences. It'll be a little bonus session. So I have one announcement to make, and then we're going to look at some of these, common or popular technical indicators, which include both trend and momentum indicators. And you might say, like, hey, what's the difference between one and the other? And well, you'll find out momentarily. We're going to look at moving averages, simple moving averages, MACDs, RSIs, or relative strength indicators. And then I'm going to look at the ATR, average true range, as well, and how one might use that. Okay, and we're going to look at how one can use these as trade signals to either enter or exit a trade. So here is, my one announcement. If you have never been to an in-person event, we are doing 24 of them this year, and Mr. Ben Watson is, attending every single one, including the upcoming Market Drive on September 20th in Texas at the Gaylord Texan, and the one at the Renaissance in Schaumburg in the Chicago area. And these events, these Market Drives, they go from, here's what's happening globally and how it impacts markets. Here's what's happening with global markets to here's what's happening, within the US of A. And, we'll talk about tariffs and trade and interest rates and all of that and how those impact the markets. We'll look at how that's impacting particular sectors. And then we go right down and look at individual stocks. And so we go from here to here all in one day. We feed your mind, we feed your body, we'll put the coffee on, we'll have breakfast for you, we'll have lunch for you, and we'll have a really awesome reception at the end of the day for these market drives. There is no cost to attend. You just have to get yourself there. We'll pick up the tab for parking. So be there, be square. I'll be at the Dallas and Chicago events. And then this event in Orlando is a 2-day event. I got introduced to this world of trading through an in-person event. I love them as a client, and I still love them as a coach. Somebody's asking about Atlanta. We were in Atlanta earlier this year, and we haven't published the schedule for next year. But Atlanta, I would say you've got a very high probability that it will be in the rotation next year. But you can go online. If you go to schwabcoaching.com, so let me just pull this up. So if you go to schwabcoaching.com and then you want to come to in-person events. Now, what we are on now is live webcasts. So if you scroll down, you can see, here we are on the 9th, and here are the classes that are being taught today. So you can see this schedule. And if you're saying like, oh, I saw Ben at a live event and he is thebomb.com. And what else, like what does he teach day to day? Here you can see the classes. He taught trading futures earlier this morning, trading index options, and then he does market movers when he's in town on Friday afternoons. Okay. Yeah, somebody said they don't want to go to New York City. There are other choices. You can go to DC. Yeah, there's an event in Washington this weekend. We are full to the rafters. So I didn't talk about that one because registration for that one is now closed. I happen to love New York, so I'll go to New York anytime that I can. But, personal preference, right? So these are the webcasts. To get to the in-person events, sorry, I went down a rabbit hole. Here's to the end of the year. DC this weekend, then Dallas, Chicago, Orlando, and then we're rounding out the year with an event in Anaheim, and registration is coming soon for Houston and Miami. And, these are 2-day workshops. Okay, so Will is on the fleeg thing. So for those of you who were in James's class, I don't say fleeg, I say flag, like bag or hag or brag or drag. But I have threatened to go and put a bunch of Canadian flags on Mr. James Boyd's lawn. So stay tuned, pictures coming your way soon. Yeah. Anyway, it's nice to be able to joke around. But I do say, I don't know, about differently, apparently. Sounds right to me. Okay, so James, welcome. If you're brand new, feel free to type a greeting into the chat so that we can welcome you. Yeah, and we hope you just keep coming back. Like I know there are people that have been through this, multiple times. Oh, sorry, I'm on the wrong one. Let me just go back. There we go. Okay. So with technical indicators, they have been created to address a range of trading styles and timeframes. And Cameron May teaches an advanced technicals class on Friday, and he covers some of these less well-known indicators if you're interested in looking at that. But most of these can be put into one of two categories: trend indicators and oscillating indicators or momentum indicators. And when we look at a trend indicator, something like a simple moving average, let me just bring up my drawing tool. When we look at a simple moving average like this line is here, that tends to be overlaid. I'm trying to change my drawing tool to something that'll show up on the chart. Those tend to show up on the chart and be overlaid on the chart. And oscillating indicators are usually in their own window below the chart. So here's a MACD. Okay, and this says it's using a 12 and a 26-day average, and that they're using exponential averages. And the no means it's, and we can, I can show you this when we add the indicator. It's not giving you buy and sell signals when it crosses this midline. You know, but you can have those put in if you wanted to create a trading plan that says, well, you want to see a green arrow on your moving average and you want to see a green or a red arrow on your MACD also. Okay. And you can customize your chart to look any way that you want. So, you know, chart tools are used to try and give you more information so that you can make a better decision. Okay, so you're trying to get greater clarity on price, position, and trend. And so these are usually constructed using historical price activity. So, you know, here it's saying you've got a 20 line and an 80 line. And when it's above the 80 line, it's saying this is overbought. And when it's below the 20, oversold. Okay. And you can have, you know, red and green arrows show up on this one also. Okay. I'm just trying to keep up with the chat. Just give me 1 second. Somebody said, one day I hope to see you in Ohio. I did go to events in Ohio when I was a client. I haven't seen one in Ohio for a while, but we were back in Detroit. And I used to live in Michigan, so I know you can drive to Ohio. You know, it may be a bit of a haul, but it's certainly drivable. And we do go to Chicago a couple of times a year also. So, you know, from Ohio, that's a pretty quick flight. But in all honesty, I thought these classes were so great that even as a client, I'd get on a plane, I'd fly to DC. I flew to Salt Lake City, ended up with a job. So like, you never know how things are going to work out in life, right? Yeah, so a simple moving average. Now, I would say, you know, maybe not every trader, but this is a very popular indicator, is to use some type of moving average. Now, if you see it say EMA, that means it's an exponential moving average. And what does an exponential moving average mean? It means that they're giving more weight to the more recent days. And you can have a 10-day EMA, a 20-day, a 30-day, a 50-day. You can make it whatever you want, a 100 or a 200. But it represents the average closing price for a stock or over a selected time frame. So if this is a 30-day moving average, this means that this is the average price of this stock over the last 30 days at this point in time. And when something gaps up and takes off, it sometimes takes, you know, a hot minute for that moving average to catch up. But this is a very commonly used indicator by technical traders. And it's a way of identifying price trend. And you know, there are traders who will use it to generate trade signals as well. And so they might say like, hey, I consider it an entry if something breaks through a moving average or if it bounces off a moving average. So they might have look at this and say, I consider this to be an entry day, this to be an entry day, this to be an entry day. Now, this gapped up pretty dramatically, this to be an entry day. They might even consider, you know, after this to be an entry day. But, you know, this is likely a 30-day moving average because a 10-day moving average would likely track a little closer. And if you're SMA is rising from left to right, that's considered to be bullish. And if it's falling, we'd call that bearish. Okay, because it means that the price of the stock is falling. Yeah. So, and so your moving average, it just kind of leads the eye, doesn't it? Both bullish and bearish. And we're going to look at a bunch of examples on the charts. But, here's our bullish signal, a price crossing above a 30-day moving average. And, this is the same chart that was on the previous page. So you might say here or here, you might have said here was your entry signal. And then, here's a bearish entry signal when something closes below. You might have said here also. Okay. Any questions on that? This is, technical analysis 101, and this is an entry to technical analysis. So all questions welcome. Now, some people will have both a moving average and something like a MACD on their chart. And why would they have both? Well, they might want to see, use it to see if the MACD is confirming the uptrend. Okay, and what the MACD does is it uses the distance between the two moving averages to identify changes in momentum. So you can see here, we had a high on the chart here and a high on the MACD. And then we had a higher high on the chart, but we didn't have a higher high on the MACD. So that might be a first indication that maybe momentum is starting to peak. And then we have another higher high, but the MACD is starting to fall. And then, this does come back. So we have this here, but one would have thought this would be up here, and it's not. And then we have another higher high up here, and yet this MACD is lower. And so we call this a divergence when the moving average is moving up, but the MACD is moving down. And so this might be a sign that this uptrend is beginning to wane. And for this reason alone, some investors might choose to have this on their chart, just so that if they're looking at two charts that look very similar, they might say, this one has a MACD that confirms the strength of the uptrend, and this one is saying, maybe caution. So, it's a way to confirm trade signals. And we call this the signal line. And we can actually get it to give us a signal, either a red arrow, this would be a red arrow when it closes below and a green arrow when it comes back above. And then some people just choose, to either use a different indicator. So some might say, well, I don't want to have too much on my chart because the confused mind does nothing. And relative strength is another indicator that you'll hear people refer to in the world of trading. And this is considered to be an oscillating indicator. It's called the relative strength indicator. And if you want to add this to your chart, if you just type in RSI. And again, we have a 30 line here and a 70 line. And when something goes below the 30, some traders would consider that to be a sign that something is oversold when it drops below that signal line at 30. And if it goes above 70, considered to be overbought. And that doesn't mean like sell immediately or buy immediately. Sometimes things can stay in a range for a while. But again, this is another thing that is commonly used for confirmation of what you're seeing in the chart. And this one, fluctuates between 0 and 100. And it's a momentum indicator. Okay, so let's go and look at some things on the chart. There's another one that I wanted to talk about called average true range. And that just gives us an idea of how much a stock moves in an average day. So let's come and look at some of these. And so let's look at Meta to start. Many of you are familiar with this company with, Facebook, Instagram, Instant Messenger. And I have a 30-day simple moving average on the chart. Now, somebody asked me about these red bars, year to date, month to date, week to date, PE ratio, etc. If you go to my X feed, there is pinned to the post there's a post pinned to the top, and it has it has the script for that if you want to add that to your chart. Now, some people like to see more than one indicator. And I was asked a couple of weeks ago, why do you have a 30-day and a 10-day on your chart? The first coach I started following used a 30-day moving average and a 10-day moving average most of the time. And his 30-day was red and his 10-day was blue. And I wish I could give you a more complex technical answer, but this is how I learned, and this is still what I do. And I make it a little thicker. You can make it any color you want. Now, if you're a longer term trader, you might want to have a 100-day moving average on your chart. So you could add another moving average. Sorry. Let me. Okay. Yeah, so we could make this a 100-day moving average. And again, I tend to make that one black. But you could make this any color you want. And if you're a longer term trader, you might say, well, I don't want a 10-day moving average because I'm not doing that kind of short-term trade stuff. And so you don't want this blue one on here. Oh, excuse me for 1 second, people. Hold on. Sorry, guys. Okay. So if we look at Meta, we've had a stock that's been uptrending since April 21st, and, you might say, well, on the 22nd, it moved up, but it was still below the 10-day moving average, still below the 30-day moving average. So some might have looked at it and said, well, when it crosses the 30-day moving average and then comes back and retests, then maybe I'll consider this, to be an uptrend. And so, it came up, it pulled back, and it looked like we did place an example trade on this day somewhere. But, this has continued to be uptrending and uptrending in a pretty significant way, such that, the 10-day moving average up until, the middle of July was acting more as a support level than the 30-day moving average. Like, it kind of blew up and continued moving up. Okay, and then it came back and it kind of kissed this moving average and played footsie with it, for a week or two. and then came up, hit a 6-month high, came down, and you'll see these little arrows. And so on the 30-day moving average, last week I taught a class in Getting Started with Technical Analysis where we had a simple trading plan. And we said, the idea is if something crosses the 30-day moving average and we have a buy signal, in an uptrend, then we'd consider that an entry. And so today, we had a red arrow saying, hey, beware. And then today we have this buy signal. Now, some might say, I'm looking also for a green arrow on the MACD, and you can add that to the MACD if you want by coming to your study, edit studies, and then you come to your sprocket and say, I want you to show me the same breakout signals that I'm seeing. And you'll see here on the 30-day, I have a yes, show me breakout signals. And on the 10 and the 100, it's a no. So I don't have a buy signal yet on the MACD. Now, the MACD tends to be a lagging indicator. And by that, I mean, it isn't as quick to respond as a moving average, depending on where your moving average is. Like whether it's a 10 or a 30 or a 100. But you might look at this and say, well, it's heading in the right direction. I'm going to go ahead and place this trade anyway. Now, if you wanted to buy the stock, it is a $763 stock. So the account we typically use for this class is this one that has just over 500,000 in it. And our position size for this account is $25,000. So we don't want to invest more than $25,000 or 5% of the account in any one trade. So we're going to divide this by 763. Say, okay, we could buy 32 shares. Now, if you wanted to do this to be, a trend trader, like you just believe in this company and you just want to own the stock, it's up 29% year to date. And that doesn't mean it's going to continue to go up. Like this could be the end of the uptrend and it could start downtrending, but the arrow is created when the stock closes above the 30-day moving average. So then we get a green arrow. If it closes below the 30-day moving average, we get a red arrow. And sometimes we can get what I call a phantom green or a phantom red, where it comes close, but it doesn't quite close below. Like here, if it had this day, at one point during the day, it was below the 30-day moving average, and then it moved above. And so if it came down here and then bounced without closing below the next day, you wouldn't have had this green arrow or the red arrow. But some might say, well, I'm going to think of that as a phantom red and the next day as a phantom green. I hope I'm not confusing you with that, but that's when the arrows appear. And on the MACD, they appear when it crosses that midline or signal line. So if tomorrow this crosses the signal line, then we'll see a green arrow. But, in this case, we're seeing, that we had a little, bump here, and then it came down. So we don't see a divergence on here saying, hey, caution, this, uptrend may not be continuing. And so that may be all we're looking for with this. And when we look at relative strength, it's saying, hey, the relative strength is uptrending again. And it's kind of right in the middle of the pack, being at 56. It's not in the overbought or oversold category. It's in neither one. Okay, so, common sense is saying AI might be a better trader because it doesn't involve emotions. I'm a big fan of having trading plans. And if you have a plan and follow your plan, I think that's one of the greatest antidotes to emotional trading. You get in when you have the signals that your plan indicates as a buy signal, and then you adjust things. And we talked at pretty significant length last week about how we'd manage this once we got in. So if we had got into Meta here on this day, we would have put, let's say we would have put our exit back here below this 30-day moving average, this recent breakout, because we had this diagonal resistance breakout line. So let me just draw that. So we might have put our first stop just down here. And then when it came up and closed here below the 30-day moving average, we would have moved our stop up to whatever our plan said, maybe 3% below. So we might have moved our stop up to here. And maybe that's what your plan for a trend trading growth stock, that might be a plan. So your stop was here, and then you move it up to here, and then it came up here. And so you go 3% below, your stop is probably around here somewhere, and you're still in the trade. But now what you're attempting to do through the use of moving your stop losses, and some traders will have a routine, where every day they go in and they check their positions, or for their growth, their trend trading growth stocks, maybe it's the first Monday of the month, or maybe it's every Monday, or maybe it's Mondays and Wednesdays, like whatever you want it to be. Okay. That's what we do. So having a plan and having a set of routines is really important if you want to become an investor and a trader. You want to have some type of system. So if we look at this and say, okay, where might our stop be put? We might say, well, this recent low here was at 721.73. So I'm going to buy 32 shares, and I'm going to put my stop at $721.73. And you might make it 3% lower. You might make it 2% lower. If you make it 3% lower, that's times 0.97. So your stop's going to be at 700.07, and you're getting in at 62. So you're risking, on 32 shares, about $1,800. And for this $500,000 account, we're saying we can risk up to $2,500 on a single trade. That's half of 1%. And so if we're saying, okay, we're okay with that, we're going to buy custom with a stop. Now, keep in mind, a stop does not guarantee that we're going to get out at a particular price. If it gaps down, we could get out at a lower price than expected. So we're going to make this good till canceled. We're going to change our quantity to 32 shares. We're going to hit this little, it looks like a firecracker to me, turn it into a paper clip. And then if I click anywhere on these two lines, it will even up. And so we're investing $24,000. We're buying 32 shares. We have a stop in place that's $62 below the current price. And then we're going to look at that weekly and say, hey, should we be moving that stop up? Is there a new established support level that it would make sense for us to move the stop up? Or if it crosses back and we get another red arrow, our rules might say we're going to move it up. Now, what if you have a smaller account? Our other account has about 32,000 or so in it. And you'd say, does that mean I can't trade stocks like this? Well, you could. You might just use options instead. And so, with this, because it's such an expensive stock, you might choose to do a long call vertical, which is you're buying a call, but because the calls are so expensive, like if we come out to October, buying one call is, you know, a $2,700 investment. And if you have a small account, like our $30,000 account, we don't want to risk more than 500. Like that's 5 times what we're willing to risk. So, you know, we might just say instead, I am going to buy the 760, and then in order to be able to afford it, I'm going to sell the 765. And so what does that mean? It means that I can only make so much money on this trade. I can't make an unlimited amount like I could by buying a call. Also, come October 17th, this trade will expire. And I've either made some money or I haven't. And we're paying $2.70 or $270. So that's a long way from the 25,000 that I just invested in buying 32 shares of stock, but I could make $230. And our example trading plan for this strategy, and I'll show you where I put it, says, hey, if we can make a 50% gain on this, we'd be a pretty happy camper, because like we're only going to be in it, you know, for about a month, right? Like this is 38 days. So if I take my $2.70 and say, well, what would a 50% return be? I'm going to multiply that by 1.5. So that's $4.05. So you might say, but you're leaving 95 cents or $95 a contract on the table. Yeah, I am. So, but how much, you know, if we're looking at this and round to 270, so if we could make $1.35 on each one of these, and we could do what, maybe 9 of them, because if we can risk $2,500, okay. Here I'm risking $2,400, and I could make, you know, if I'm doing 9 of them, and I can make maybe 130 on each one, I'm still making over $1,000. You know, if you're looking to generate some income from the portion of your portfolio that you're not, you know, even if in a $500,000 account, you might say, well, you know, I'd like to have some stocks that I'm investing in, you know, for the longer term, but I'd also like to have some way of generating income. This might be a potential income generating strategy. And it's risk defined in that the most you can lose is 2,400. The most you can make is 2,000. But maybe you just like a little extra wiggle room in your, you know, whatever your month is, or you have a trip you want to take or whatever. You know, so this could be a potential income generating strategy. And this could be, you know, a tool, you know, a pretty rudimentary tool that we use to decide when we want to get in. Okay. I don't know if I put in my exit on that. If I didn't, I'll go back and add it later. Okay. So I want to look at another stock. And that is, let's look at Goldman Sachs. And excuse me for leaving this. We're going to talk about this tomorrow, either tomorrow or Friday, because we had done a different type of trade. Let me just edit this to kind of clear that off. But here's another case where we have a stock, you know, that's been uptrending. This 30-day moving average has been acting as support. And when I talked about something we'd call a phantom red, we could call this a phantom red, because it came back and kissed that 30-day moving average, but it ended up not closing below it, although it traveled below it during the day. And so if you were doing your weekly routine, let's say we bought this stock back here when it crossed the 30-day moving average and we wanted to see it come back and retest and then bounce. So let's say we bought it on this day, and this is just kind of a basic plan. So, you know, at this point, dang, I don't know why my drawing tool doesn't want to work. So let's say we bought it this day. I'm giving up on my drawing tool. Okay, so our stop is here. When it comes down and we get this phantom red, we might adjust our stop to 3% below and then move it up again. And then another phantom red, but it didn't end up closing quite below, move it up again. And this is just all part of your weekly routine. But you might say, hey, we had and you know, how come I'm not seeing these arrows here? Because it didn't close below. It did on this day, and then we had a green arrow here, but because this didn't actually close below, we didn't get another arrow. But could we still consider this an entry? We might. And so we could go through this same process to either, you know, add some shares of stock to our portfolio. Now, if you wanted to do a shorter term trade, you might say, well, how much does this stock move in an average day? And here's one where we have the green arrow here. And if you wanted to put in a short-term target, this is where some traders might look at this average true range. And what this 14 means is this is what the stock, how much this stock has moved from open to close. You know, so if you have a candle that looks like this and a wick at the top and the bottom from open to close, high to low over the last 14 days, it's moved on average $15.81 a day. So some traders might say, well, if I wanted to do a short-term trade, I'm just going to buy the stock and add $15.81 and make that my target. That's how some people might use ATR. Okay. Does that make sense? Okay, so Chris is bringing up a good point. He's saying, you've mentioned before that you wouldn't want more than 5,000 in any one stock position, assuming that would be stock. That's 25% of a 20K portfolio. So do we look at risk differently with stocks and options? So I like your question. And so here's the two accounts, and we'll have to close on this. But one account I started the year with at 25,000. I think we're just over 32,000, but we still position size based on the 25,000. Now, some of you might say, well, I'm going to revisit that every quarter. You can do it however you like. But because our targets were kind of aggressive in the beginning with this account, we said 5K was our max position size. And that represented 20% of our total account value. And then our max loss per trade, 500, which is 2.5%, right? Or 2%. Now, if you have, and then we had this $500,000 account, and on that one, we said, you know what? We don't want to risk more than 5% of our portfolio on any one position. So we made that 25K. And we don't want to risk more than half of 1% on any one trade. So, you know, this is why I'm not adjusting this, because 2% is kind of in a more aggressive position. And 5K is a more aggressive position size. And this 5K is for stocks, so we can do buy right covered calls and that kind of thing. But this is a personal preference. But this allows us to buy more stock positions where if it's a $50 stock or less, we could buy 100 shares. Okay. So, but as your account grows, you may want these numbers to go down. And so it depends on the amount of risk you're willing to take. It depends on your account size, all of those good things. Some people might say, I'd rather make this 250. Well, go ahead and do that. You know, you can do it however you like. But guys, I thought this was a great conversation. I really appreciate your feedback. This will be available in the archives. It is being recorded. And every day the ATR is updated. Every day the 30-day moving, all the moving averages are updated. The MACD is updated. So these all, the system updates daily. So guys, thank you for joining me. Don't forget, hit like, hit subscribe. Don't forget to follow Ben and I in the land of X, Ben Watson CS, Barb Armstrong CS. And I hope to see you in Dallas or Chicago or at an upcoming event sometime soon. If you're at a live event, you'll see Ben Watson on stage. And it is a sight to behold. I can guarantee you that you will learn something. So guys, thanks for being here. We'll see you in a webcast coming up soon. Bye for now.